I'm Jitesh from Trident Utilities, and today I'll be covering the latest price dynamics, demand and the wider energy market. As the summer season progressed, a narrowing price trend emerged. The summer 24 gas contract fluctuated 34% in Q2 23 and 20% in Q3 23. The supply contract has developed a strong resistance level above 145 pence per therm after failing to breach this mark on 3 occasions. Recent volatility has been sparked by supply-side factors such as extensions to Norwegian maintenance, along with headlines around the resumption of potential LNG strikes, suspected sabotage of the Baltic interconnector, and the Middle East conflict, which led to UK gas prices surging 35%. This level of volatility demonstrates how the European gas market has become structurally tighter since the Russian gas supply cuts to Europe, and how any further small changes to the market balance has led to high asymmetric price risk and volatility. Downside price risks certainly exist in the form of negative demand shocks from a recession or another mild winter and healthy supply volumes. However, European and Asian gas demand are already weak, with price support from substantial coal to gas switching volumes across the European power sector, with the first winter without German nuclear, which places further reliance on alternate fuels. This winter, uncertainty around demand will remain a challenge in relation to weather conditions and the extent to which economic weakness will translate to continued weak gas demand. Behavioural changes have also contributed to demand reduction as people are less negligent to waste energy, leading to changes in heating patterns. UK gas demand is currently 6% above the 6-month rolling average, with the strongest increases observed in LDZ demand, which recently shifted above normal levels, followed by a slight increase in industrial. However, weakness in gas requirement from power generators persists due to healthy renewable generation and improved nuclear output. In contrast, total monthly gas consumption in Northwest Europe remains below levels observed this time last year due to continued weakness in Germany's industrial demand. Over the past year, industrial demand reduction has been linked to offshoring, shuttering of production, energy efficiency measures, and hedging constraints due to unfavourable prices over the next couple of years for large manufacturing plants. On a broader perspective, the Eurozone PMI data has also shown weakness in manufacturing, especially in Germany, who account for almost half of Northwest Europe's industrial offtake, which recently hit a 40-month low. Forward indicators such as new orders have also fallen to the fastest rate since the start of the pandemic, impacted by lower consumer spending due to inflationary pressures, which points to weak macroeconomic outlook in Europe. This winter, the demand recovery in Asia is expected to be limited. China has seen a recovery in LNG imports this year. However, imports are forecast to moderate, with the demand growth forecast to be 9% higher winter on winter. Other countries such as Japan and South Korea are expected to see reduced LNG demand due to increased nuclear availability and new coal-fired plants. Based on changes in total supply and demand, LNG imports into Northwest Europe could be around 4 BCM higher compared to last winter, although weather patterns will be a key driver. The ongoing El Niño event in the Eastern Pacific Ocean increased the likelihood of milder temperatures for China, Japan and South Korea, when observing similar levels historically. In Northwest Europe, longer-term weather forecasts point to low northeast Atlantic pressure, driving a milder temperature scenario over the next couple of months, although uncertainty over the strength of wind speeds remain, which could create high fluctuations in day-ahead markets. Forecasts into the new year suggest temperatures in the UK and Europe could be volatile, with possibility of wetter and cloudy conditions which could swing gas for power demand.
My name's Alexandra Mottershead. I'm a risk manager here at Trident Utilities, and today I'll be covering some of the supply fundamentals for the next few months, and at the end of the video making some recommendations on how to mitigate the expected market volatility in the coming months. Global LNG supply is set to increase by 11.5 BCM year on year this winter, with 8.5 BCM coming from the US alone, following the full return of Freeport. Around 4 BCM of this supply should arrive into Europe, and so far this year, Northwest Europe has attracted 67 BCM of LNG. And this highlights Europe's progress in replacing Russian supply, given that Nord Stream delivered around 59 BCM of gas into Europe in 2021. Much of this transition has been possible due to floating storage and regasification units, of which multiple have been procured across Europe in the past year, with further units set to be online into Q1 24. Europe has also managed to secure additional longer-term LNG deals in recent months. Most recently, Qatar struck 2 27-year deals with Shell and Total Energies to deliver a combined 7 million tonnes of LNG per annum to the Netherlands and France. Despite this progress, 40% of LNG arriving into Europe is still bought on the spot market, and so drivers in this market remain key. Current netbacks generally favour Asian markets for Europe's main suppliers of LNG, the US and Qatar. However, once shipping rates are accounted for, European markets are currently more favourable to US exporters. Weather will be a key factor in driving spot prices over winter. If we do see colder temperatures in Asia, this will drive spot prices and incentivise more cargoes eastwards. Earlier this week, news of an agreement between Chevron and its Australian workers was welcome news for the Asian LNG supply picture. Further strikes have been averted, and it's hoped that the agreement will be ratified without further delay. Although, unions have warned that if Chevron tries to alter the deal reached, workers could vote to strike again. Norwegian flows are expected to remain steady over winter, following a heavy summer maintenance schedule. Delays at Nyhamna and Troll saw capacity cut significantly compared to typical summer schedules. The summer 24 maintenance schedule is much lighter, which will be key for replenishing storages for winter 24. Some 2.5 BCM of foreign gas has been pumped into Ukrainian storage in recent weeks, as Europe's caverns have reached 98% fullness, with the UK now 95% full. Current central cases put forecasts for Northwest Europe storage at around 40% full at the end of winter 23, and this would be just below the levels at the end of winter 22. Russian supply via Ukrainian routes remains steady, and this is expected to continue until January 25, when the current transit agreement with Ukraine ends. Gas flows could theoretically fall to zero at this point, but Russia could still book capacity at future auctions. The picture for French nuclear has vastly improved year on year. Current output sits at 70% of capacity, compared with just 48% in October 22, and current forecasts show up to 90% of capacity could be online by peak winter. This is in stark contrast to December 22, when just 65% of capacity was online. Whilst the supply and demand picture fundamentally looks positive, recent geopolitical developments have injected volatility into markets on fears of potential disruptions to European gas supplies. Damage to the Finnish-Estonian gas interconnector lately roiled markets as it highlighted the remaining vulnerability of Europe's piped gas infrastructure. The recent escalation in the Middle East has raised concerns of conflict spreading to surrounding nations, with potential for some key global energy players to be impacted.
In the wider market, Brent oil has appreciated by 22% since the start of Q3 23, with the front month contract now trading above $91 per barrel. A tighter market balance has been related to slow demand recovery as central banks hold on to high interest rates to tackle inflation, which took the US dollar to an 11-month high. Meanwhile, the extension to the OPEC Plus supply cuts to the end of the year and US stocks falling to the lowest since October 2014 provides price support. Updates from the IEA and OPEC point to strong growth in global oil demand in 2023 and 2024, citing signs of a resilient world economy, with China considered the engine of oil demand growth this quarter, who have started to show economic recovery in the third quarter following a series of stimulus measures. The UK and European carbon markets have experienced a high rate of convergence through Q3 23, with the December 23 EUA contract almost holding a 47 euros per tonne premium against the UKA's in mid-September. This was due to UKA's falling to a historic low as the UK government announced a change in several climate policies, which makes conditions to reach net zero by 2050 much tougher. In contrast, EUA's held onto much of its value due to the build-up of net short positions by investment funds and periods of TTF prices trading above the average coal switching price, which is expected to remain competitive into the new year. Since this point, the price spread between the two markets have narrowed to levels last observed in June, as the UK government announced that the UK ETS will be tightened in 2024 by a 12.4% reduction from its current year as part of the broader ETS reform package.
Whilst the fundamental supply and demand picture is currently bearish, volatility will remain a theme throughout this winter and into 2024. Markets continue to be extremely sensitive, and managing exposure to wholesale market volatility will be key in the coming months. A progressive flexible strategy solution remains the best tool to reduce the risk of purchasing in a high price environment. For larger energy users, this can be achieved with a flexible energy contract and a comprehensive risk management strategy. Trident's framework solutions provide a facility for purchasing energy flexibly for customers who cannot access standalone flex contracts. We operate a variety of risk strategies within our framework to cater for a range of risk profiles. For customers requiring fixed contracts, preparedness will be key in order to secure contracts quickly if we see known or unknown risk factors materialising. Therefore, we would encourage these customers to issue their tenders to the marketplace now to streamline the process of accessing prices over the winter months. That brings us to a close on this update. If you have any questions, please feel free to contact us. You can also find the latest energy market commentary from our experts on the Trident Utilities website and social media platforms. Thank you for listening.